Okay, excellent. Okay, so the first bit that I need to discuss with you is theory relating to partnerships again. Okay, and you'll see why. Because in study unit 4, we're focusing on liquidations. Okay, so when looking at theory versus application, if I understand theory, it helps with the application. So this is the one section where the textbook is really, really very good. Okay, so if you have gone through any of the material, you'll see they discuss the theory in a lot of detail, and they give some additional workings there for another method. There are two methods when looking at a liquidation. We're going to be looking at simultaneous, and we're going to be looking at piecemeal. Simultaneous, and we're going to look at piecemeal.
Okay.
With piecemeal, you also get two different ways of doing the calculation. So there's a surplus method and there's a loss absorption capacity method. That's the one that UNISA likes, and they don't test the other. Right, it's excluded from your learning outcomes. They don't cover the other method. They only cover the one. And you'll see why later. It makes a lot of sense using the loss absorption capacity method rather than the other one. So in this particular section, if you do go through the theory, it does help quite a bit, but we'll discuss the most important points now. Okay, so when looking at a partnership, do they always continue?
No.
No. When can they end?
Well, when one partner pulls out.
Correct. Okay, so do you agree? We've now looked at study unit 3, which is focusing on a change in ownership. What did you actually do with the change in ownership?
So we calculated what share belongs to and what share the new guy is willing to buy.
Correct. So in that particular question, you actually closed the business and then you started a new one. Do you agree?
Yep.
So when you had A and B, okay, we just looked at an example where we had a new partner coming in. So A and B running a business. If they then create ABC, what do we do with the old business? We actually remove it. We get rid of it.
Yeah.
Do you remember we had the legal perspective and the going concern?
Yes.
So legal means we close the old entity and we start a new one. That was example 3.2. So when approaching a liquidation, study unit 4 is actually easier than study unit 3 because you're actually going through the motion of valuing the assets and liabilities, then allocating the worth to the partners before closing the accounts. Right, so when you see the word liquidation, you're focusing on what?
Closing it off.
Correct. Selling assets, paying liabilities, and determining equity. If there's something left over, each partner is paid out.
Okay.
Okay, so A and B are going to close the partnership. They'll liquidate the partnership. Does a partnership always liquidate when the business is doing badly?
I don't know.
No. Okay, a partnership can liquidate when the business is doing well. What happens if B decides to retire?
Yeah,
Will that partnership continue?
No.
No. So in actual fact, the partnership is being liquidated because B is going to sell his or her share in the business, get paid out, and then A might start a new partnership with C.
So liquidation is not necessarily a bad thing.
No, liquidation is not necessarily a bad thing. When you see the word liquidate, to liquidate just means to sell assets.
Okay.
Okay, so normally you associate a liquidation with this word, insolvency.
Exactly.
Okay, and the reason why that word is associated with liquidation is because when there is a business that's bankrupt and they're and they're basically insolvent, the business needs to liquidate. So liquidate means sell all your assets, pay for all your liabilities, and whatever's left over goes to the partners. But if the business is insolvent, there's nothing left over. So then what happens then?
Well, then I suppose it's closed shop.
No, it's not just closed shop. So, okay, example. This is a good example. Let's discuss what you've mentioned. Okay, so A and B.
Yeah.
Let's say A and B are running a business, okay? Their assets are 50 and their liabilities are 70. Is that an insolvent business?
Yes.
Yes. Okay, so A and B have now decided to liquidate the partnership. Right, so what's going to happen to their assets? They're going to sell it, right?
Oh.
Okay, so if they sell the assets, they realize 50. What's going to happen with that 50? Are they going to pay themselves out 25?
No, they're going to pay it to the credit, to the people that owe money first.
Exactly. This takes preference.
Yeah.
Okay, so the 70 must be paid first. Once you pay the 70, only then can the partners take from the business. So remember we spoke about unlimited liability earlier on in the semester. Okay, what does that mean?
Well, it means that they still have to pay up that 70 in terms of liability.
Exactly. So do you agree, if I look at this partnership, A and B have a business, and on paper, the business has 50 in terms of assets and 70 in terms of liability. So this business is worth nothing. They can't pay all the outstanding debt. So once they've sold everything, they're still owing minus 20.
Yeah.
So what are the creditors going to do?
I suppose they're going to write off that money.
No, the creditors are going to come to A and B individually, and they're going to take personal assets.
Oh, okay.
Because that's unlimited liability.
Okay.
Okay, and that's why partnerships and sole proprietors are risky, because if you don't manage your assets and liabilities, you could have a situation where your private assets could be taken to cover the expenses of the business.
Shit, okay.
All right, but if this was a company or if this was a CC, well, then you literally just write it off because it's a separate legal entity.
Okay.
Okay, but in today's world, there's obviously a lot more legislation around companies and CCs to avoid people taking advantage of that. Because then what could you do? Well, start a CC, incur lots of liabilities, pay out everything to the company owners, and then just leave the empty shell with all the liabilities. See, things like that. And that's part of the reason why you can't register a new CC, because in the past, people used to abuse that form of ownership. Okay, does that make sense?
Yeah, it does make sense. If I remember correctly, now to start a company, you need like 50 people, or there's a certain number of people.
For a company, you do need people, and you also need a lot of paperwork. You need to go register at the CIPC. You've got to fill in all the documents. You need an accounting officer. All of that stuff you need to do.
Okay, perfect.
So it's also more. Let's say more admin that you need to do in order to create the business. If it's a company that you're looking at creating.
Okay.
Okay. So when looking at this specifically, liquidation, solvency, and sequestration. Okay. Remember, it could be any of those three. They all mean the same thing. What do they mean? Sell assets and pay the liabilities. And what's left goes to who?
The partners.
The partners, exactly. So always remember this. NB. Liabilities always before partners. Always. Because of what? Unlimited liability.
Okay.
That's the key. See, that's the theory. So now, if we understand the theory, we can understand the accounting. Because those partners are going to be part of the business in the good times and the bad times.
Okay.
Okay, so if they decide to liquidate the business and there isn't enough to pay out all the partners won't get anything. Or the partners may even have to pay more toward the business to close it.
Okay.
Okay. All right, so the two types of liquidations you get. You get a simultaneous liquidation and you get a piecemeal. Right, tonight I'm going to focus on this one, simultaneous.
Right.
On Wednesday, I'm going to focus on the next one, piecemeal.
Okay.
So what do I need to do those liquidations? Well, here's the answer. With a simultaneous liquidation, just think about the word simultaneous. It means to do everything at once. Okay, you're doing different things at the same time.
Okay.
So when doing a simultaneous liquidation, everything is sold off and everything is going to be liquidated. So if I'm liquidating everything, this is the account that I'm going to need to look at, liquidation.
Account, okay.
Right, I've referenced this as a garage sale. Okay, so think about moving house. Okay, if you're moving from one place to another, you might not be able to take everything. So you might say, well, what I've got, let's just sell it to whoever wants to buy it, and then whatever I can't sell, I just leave.
Okay.
Okay, so a liquidation is looking at exactly that. It's looking at selling everything, get what you can, and then move on.
Okay.
Right, piecemeal is different. Piecemeal looks at selling things in stages. Okay, so let's say we've got a building, and let's say the building is worth 50. Okay?
Yeah.
Is it always a good idea to sell the building at a particular point in time? So let's say if we've got a recession,
Yeah.
and that building is worth 50 on paper, do you think we'll get 50 for it?
No.
Why not?
Because, I mean, it's a recession, so the economy is down, so people won't necessarily have money, so they're going to offer you less.
Correct. Okay, so in that scenario, if we're going to be liquidating the partnership, we might not even get close to 50. We might only get 25.
Yeah.
So now, are the partners going to be happy with that?
No, not at all.
Definitely not. Okay, because you've had this building for the last few years, right? To sell it at such a discount wouldn't make any sense.
Exactly.
And that's why you've got a piecemeal liquidation. So a piecemeal liquidation looks at selling assets off in stages. So we won't sell the buildings today, but we'll sell all the equipment and the vehicles.
All right.
Later on, when we sell the building, then we'll look at it and then we'll apportion it or we'll share it amongst the actual partners. So those are the two forms of liquidations. The one is you look at everything once off, and the second is you look at everything but over stages. So you use a column for that. Okay, you use columns and you use a table. That's how we approach it.
Okay. So
Right.
so
Yes.
to liquidate the partnership in this context that we're studying it in now,
Yes,
does it always mean the partnership comes to an end?
correct.
Okay.
Okay,
Because
this partnership will not continue. So that's a good point that you mentioned. All right, so how is study unit 3 different to study unit 4? Well, study unit 3 looks at the business continuing. So it ends on one day and then it starts the next day.
Okay.
That's the change in ownership.
The reason why I'm asking is I just thought of something. So, when you talked about this building now that we sold.
Correct.
So there will never be a case where, let's say, we're going to try and sell the stuff inside the building to try and save the partnership. There's no scenario like that.
No scenario like that. Yeah, if it's a liquidation, you've made the decision to stop operating. Okay, there's no operation. So you're not, if you're still selling assets to keep the business alive, then that wouldn't be a liquidation yet. Okay, that'll be a disposal of assets. Okay, so if you're selling the equipment in the building to keep the business alive, well then you're going to have lots of asset disposals that you'll have to account for in the normal records of the business.
Okay, perfect. That makes sense.
Okay, you don't treat it like a liquidation. This is only applicable when a partnership ends.
Okay, perfect.
Okay, because we know these partnerships can end for a lot of different reasons. Partnership retires, it'll end. If they don't continue after that, it's a liquidation.
Okay, perfect.
Okay, if a partner retires, but then the existing partners still continue with other partners, then that's a change in ownership.
Yeah, 100%.
Got it.
Okay, perfect. That makes sense.
That's a good question. That's a really important question because this is looking at the end. There is no continuing at all afterwards. It's close of business.
Okie dokie.
Okay. All right, so this is the one we're looking at tonight. Okay, simultaneous liquidation. Trading is discontinued, so all assets and liabilities are realized. Realized or liquidated. Okay, that's the keyword, liquidate. Liquidate means to sell, get cash, pay out who first?
The liabilities.
Good, it's always liabilities first, and then we pay out the partners. So when looking at a simultaneous liquidation, there are only going to be 3 accounts that you need to look at. Okay, because think about it. Is this business going to continue?
No.
No. So am I going to have normal accounts that would be viewed in terms of operation? So will I have a sales account?
No.
No. Will I have land and buildings?
I suppose yes.
No. Okay, I'm not going to have any of those accounts because what am I doing?
But don't you need to determine the worth of the land and buildings to sell it?
Yes, you do, and you do that in a liquidation account. So the only accounts that you're going to ever see in a simultaneous liquidation type question is bank, because what do I want to do? I want to liquidate. Liquidate means to sell things and realize cash.
Okay.
That's why I've got bank. If you're looking at a liquidation, then you're going to have a liquidation account.
Okay.
Okay, because you're selling everything. And who owns the business?
The owners.
The partners. And what accounts represent their worth?
Capital.
Capital. So you'll still have capital. You'll have liquidation for everything. And when I say everything, I mean everything. Literally anything that you have in the question, you're going to put in the liquidation account.
Okay.
Because the business is closing its doors. And it's happening all at once. It's like a garage sale. Okay, it's instantaneous. Okay, what I have is what I sell. Whatever we realize, we pay the partners.
Okay.
All right, so that's important. So from an accounting point of view, okay, not looking at the theory so much, just the accounting. Those are the 3 accounts you need to draw up.
Okay, perfect.
Okay, the steps are very basic. When looking at step 1 and 2, it doesn't matter which step you start with. You can either close drawings, or you can close goodwill, or you can close the reserves or the current account. It doesn't matter. But the main focus is this, the capital. Why do we close everything to capital?
Well, to see if there's any money left.
Correct. It's the ownership, it's the entitlement in terms of the ownership.
Okay.
Okay, we know capital is the most important account. It was important when we looked at a change in ownership. It's still important when we look at a liquidation because it tells you how much is left in the business.
Okay, perfect.
All right, and then step 3 is to prepare the liquidation account, and we'll look at that. Okay, I used blue here because this is new. This is the only account that's new in this section, liquidation.
Right.
And what is liquidation? It's an account that's a working account. So does liquidation have an accounting element?
No.
No. Does valuation account have a element?
No.
No. They're all working accounts. They work something out. Those accounts don't have balances. Only accounts with balances meet the definition of assets, liabilities, income, or expenses, or capital drawings. All right, and then the last step is to settle the capital, if there is anything to settle.
Okay, perfect.
Great. All right, so here's a note about what the account looks like. I'm going to show you what the account looks like in terms of a practical example, okay? But for now, we just need to understand how this account works. Okay, so you know you're going to have to draw it up. You know you'll have 2 other accounts, bank and capital.
No.
So this new account, how does this account function? Well, let's look at different examples. Assets. Are we going to sell assets?
Yeah.
Are we going to keep those accounts open?
No.
No. So how do I close an asset account?
You credit it.
Good. See, that's your rules coming into it. Okay, so you know an asset, okay, is going to have a debit as an opening balance. To remove it, I'm going to have to process a credit. So if I process a credit, where's the debit going to go?
A process a credit.
Remember, all debits have to have a credit. So you just told me I'm going to credit the asset. So where's the debit going to go?
It can't be expense.
No, because you don't have any expenses. Remember, you only have 3 accounts. Will it go to bank, capital, or liquidation?
One of those. It'll go to bank.
It can't go to bank because you haven't sold it yet.
Oh, okay. Well, then it will go to capital.
It can't go to capital because that's the owner's entitlement.
So where's it going to?
Liquidation.
The liquidation.
Hey,
Okay.
remember we said everything goes to this account.
Oh, all right.
Okay, so it doesn't matter what it is, it's going to the liquidation account.
All right.
All right, another question. Let's talk about another example. Liabilities. What balance will a liability have?
Credit.
Good. So let's talk about a loan. The loan will have a credit here. Okay. How do I close off the account?
A debited.
I debit that account. So if I debit the loan, okay, there's the debit. That closes the account off. What do I credit?
The liquidation.
The liquidation again. Okay, so see, that's why you do what you're doing. Okay, that's just understanding. Right, if you don't want to look at it that way, you can just treat it normally as what? An element. Okay, this is almost like the shortcut, if you will. Okay.
Okay.
So I know what it is, so I know what balance it will have, right? So what is an asset? An asset is an asset, it's a resource. If I know it's an asset, where do I put the balance?
On the debit side.
On the debit side. So even in the liquidation account, assets will be put on the debit side.
All right.
Okay, you can just learn it that way. You can just do it that way. Okay, but I obviously wanted to give you more in terms of understanding, because if you know what the asset is, you'll know how to close the account off. That's why I spoke about that initially. Okay, this is just the shortcut. Okay, so assets go on which side? The debit side of liquidation, because assets have debit balances.
Okay.
Okay, where would I put liabilities?
On the credit side.
Exactly, because they have credit balances.
Yeah.
Where would I put income?
On the credit side.
Good, because they have credit balances. And expenses?
On the debit side.
Exactly. All right, so if we keep it as simple as possible, just remember your accounting rules. You've got 6 rules that you need to learn and you need to apply. So I'm applying the rules even in a liquidation question.
Okay, perfect.
Okay. Something else that we need to look at here at the bottom is entitlement. Okay, so when looking at a liquidation account, you are going to have a balancing figure. And the balancing figure will either be on the debit or the credit. Okay, so if I have a balancing figure on the debit, what am I doing to the account? Well, I'm debiting the account with liquidation. Okay, and if I'm debiting liquidation, I'm going to have to credit the capital. Right, so if you're crediting capital, what's happening to the account?
Sorry, say that again.
If you're debiting liquidation and crediting capital, what are you doing to the capital account?
You are increasing.
You're increasing capital. So are you increasing the owner's entitlement or decreasing their entitlement?
You're increasing it.
You're increasing it, correct. So if I'm increasing their entitlement, the debit on the liquidation account represents a profit that's being transferred to the owner. Okay?
Perfect.
And then the same thing happens on the credit, except the credit represents the transfer of a loss. Right, because now what am I doing to liquidation? I'm crediting liquidation. So if I'm crediting liquidation, I'm going to debit the capital. If I debit capital, are we increasing or decreasing the entitlement?
Decreasing.
We're decreasing entitlement, and that's why it's viewed as a loss. Okay, so it's a bit different here because you're looking at the effect on capital. You're not looking at the actual amounts. Okay, you're looking at how do I affect the owner's capital.
Okay.
Is that all right?
Perfect.
Great. Okay, and that's where we're going to end for tonight in terms of the theory. We're now going to look at the working. Okay, so I'm going to start on Wednesday with this slide. Okay, we'll come back to these notes then. Okay, there are 2 more slides to look at there. I need to cover exercise 4.1 now with you. Okay, so I'm going to put up the question quickly. Here's it. Okay, study unit 4. We're looking at 4.1, which is your first example looking at a simultaneous liquidation question. Right, so it doesn't matter what question you've been given. Step number 1 is to do what?
Look at the elements.
Good. Okay, so quickly go through the elements, right, and tell me what they are.
Okay, so land and buildings is an asset.
Good. Okay, so if you know it's an asset, where am I going to put assets? Let's apply the theory. Well, let's do both at the same time. So we cover the rules and then we also look at the actual accounting. Okay, so what am I going to be required to do here? If you look at the dish information, they want you to draw up this. Okay, the general ledger, the T accounts. Okay, so let's draw up the T accounts. I'm going to need a big T account for which one?
For liquidation.
Good. Okay, so massive T account. Debit and credit side. Let's put a heading.
Liquidation.
Liquidation. Okay, what other accounts will I have open for a liquidation?
Well, bank and capital.
And capital. Good. Okay, and that's it. Nothing else matters for a question like this. Capital. Okay, which partners do I have?
Pen and pencil.
Okay, let's put that in. Pen, pencil. Good. All right, so now we go to the question. So coming back to what we just said, you told me land and buildings is what?
Asset.
Good. Okay, so you know what it is. Okay, so now we need to get a mark for that. You know what it is. You know how much it is. 500,000. Okay, so if it's a simultaneous liquidation, you've got capital, you've got bank, and you've got liquidation. Which account are you going to choose to record that in? You've only got 3 accounts. Bank, capital, liquidation.
Liquidation.
Good. You see, everything gets closed off, and you've got 3 accounts to consider. Capital, liquidation, bank. That's it.
Okay.
All right, so if we know it's an asset, which side of the account are we going to put it on?
On the debit side.
Exactly. Okay, land and buildings, open brackets, 500. Okay, we may or may not have to adjust. Depending on the complexity of the question, we might adjust depending on what we have later. But let's get some part marks. Okay, read the next one for us.
Furniture at cost, also an asset.
It? Good. Where does it go? Liquidation, bank, or capital? You've got 3 options.
Liquidation on the debit side.
Good. Amounts?
102.
102.
Yeah, 1,000.
102. Yeah. 102,000, right?
Yep.
Thanks. Okay, next one. Read the next one.
Vehicles at cost.
What
Same
is
as above. Yeah, it's an asset in a liquidation account on the debit side.
Perfect. Okay. Amounts?
215,000.
215. 215.
15, yeah.
Great. Okay. Next account.
Accumulated depreciation.
What is it?
It's a negative asset.
Good. So what balance do they have?
They will have a credit balance.
Good. So where does it go?
It
Bank,
will go
capital,
to
liquidation.
It will go to liquidation but on the credit side.
Perfect. See, that's all you need to do is just identify what it is.
Okay.
Allowance, not allowance, sorry, you said accumulated depreciation.
Yeah, accumulated depreciation.
For what asset?
For furniture.
Okay, accumulated depreciation, furniture. Amount?
20,000.
20,000, great. Okay, continue. Next one.
Next one is also a negative asset. It's accumulated depreciation, but for vehicles.
Perfect. Okay, so same reason here.
Yeah, 15,000.
Good. Okay, next.
Next one is goodwill.
What is it?
That's also an asset.
Good.
So it's
okay, but what asset is goodwill? We can't only say it's an asset.
The current asset.
Yes, it's a non-current asset, but what is goodwill?
It's a reputation.
Correct. For who?
For the old partners.
Yes, good. Okay, so here's a note. Goodwill is a non-current asset for the existing partners. All right, yeah. When does goodwill arise? You've just covered it today.
When the partnership ends.
No, goodwill arises when someone's buying a share of the business.
All right.
Okay, so that's when it arises. So has this company had a change in ownership in the past?
I don't know.
Yes, they have to have one, because if they didn't, there wouldn't be any goodwill.
Okay, perfect.
Okay, because remember we said before the break, goodwill is created when we buy a share of the business.
Okay, perfect.
Okay, so now we've got a share of the business in terms of the goodwill having been created. Okay, when is goodwill an asset? When we operate or when we close the business?
When we operate.
Exactly. Okay, because what did we say it was? It's reputation, brand, and so on. Yep. Okay, so if this is a simultaneous liquidation, if this is going to be a sale of all our assets, is anyone going to buy the reputation and brand?
No.
No. No one's going to buy that because the business is going to end.
Okay.
Okay, so goodwill is a benefit if you continue to operate. Goodwill is bad when we stop operating. Because what are you actually doing? Let's think about it from the partner's perspective. Pen and Pencil have been operating. Have they generated goodwill?
Yes.
How much was the goodwill on the books?
120.
120. Okay, so if we continue operating, if Pen and Pencil had to continue operating, their brand, their reputation, all of that is going to continue with the business.
Yeah.
Are they going to be closing the business?
Yes.
Yes. So who's going to buy this?
No, nobody.
Nobody. So who has to take that as an asset?
The current owners.
The current owners, exactly. Okay, so how do you reduce goodwill?
Well, it's an asset. They're going to have to credit the asset account.
Good. So you have to credit the goodwill. Perfect. There you go. You've applied the rule. Asset decrease. Right, now what am I going to debit?
The capital account.
Very good. Capital for pen.
Capital for pencil, yeah.
For pencil, exactly. All right, does that make sense?
Oh, 100%.
Okay. How much do they each get?
Well, they don't say if it's 50-50 or anything, so I don't know.
Check the question carefully. They do say.
So to liquidate portions of public auction. Okay. We're sharing profit or losses equally, yeah, so it's 50-50.
Yes, okay, so that's important. All right, so
Okay.
don't worry about the different amount because it's just half-half, so I'm just going to divide by 2. Okay, there's no fancy fractions here. We can just divide the 120 by 2. So I'll have 60 for this partner
Yeah.
and 60 for that one. Okay, but does that make sense? Does the theory make sense?
Yeah, 100%.
Good. Okay, so goodwill is only an asset if you keep operating. As soon as you close your door, goodwill no longer becomes a benefit because all the brand and reputation is literally being thrown away by the partners.
Okay.
Okay, so now what am I going to do to goodwill? Debit or credit the account?
You are gonna credit it.
Yes, okay, so I just want to show an extract here. Okay, goodwill would have had a balance of 120 here, and that would have been the balance that you had on the actual books. Okay, so if I'm debiting the capital accounts, I'm going to credit the goodwill.
account.
All right, so that's what I'm doing here. Do you see? I'm processing the actual goodwill.
Yes.
I'm writing off goodwill to their capital accounts.
Perfect.
$60 for that partner, $60 for this one.
Yes.
Capital pen, capital pencil. Happy?
Happy.
Good. All right, so next, read the next account for us.
The next one is inventory.
Good. What is it?
That's an asset.
Where does it go? You've got 3 options: liquidation, bank, or capital.
Goes to liquidation.
Correct. Inventory, what's the amount?
The amount is 45,000.
Great, thanks. Next one.
Trade receivables control. So that's debtors. It's an asset. It goes to the liquidation account on the debit side.
Good. What was the amount?
75,000.
Perfect. Next.
Allowances for credit losses.
What is it?
Negative asset.
Good.
So it goes to the liquidation account, but it goes to the credit side.
Nice. See, you know your rules so well. It's so easy to do this. Okay, what's the amount?
7,000.
Nice. Keep going. Next one.
Next one is capital pen.
What is it?
So
Debit or credit?
that's capital. Oh, it's a credit.
Good.
Yeah.
How much?
So 150,000.
Okay, so 150 for pen. Good. Keep going. Next.
The next one is capital for pencil. It's also a credit of 80,000.
Perfect. Get our easy mark. We know where those go because we know what they are.
Okay.
Keep going.
Then we have got a current account.
Okay, what is current account representing?
And it will represent bank, I suppose.
No, current account represents the short-term entitlement for the partner.
Yeah.
Okay, so is this business going to keep operating?
No.
No, so there's no short-term entitlement.
Okay, so it
we
goes
need
to
to close
liquidation.
that off to capital, drawing, not capital, capital, bank, or liquidation.
I would say liquidation then.
Okay, liquidation is looking at all the assets, liabilities.
Oh, okay.
Income and expenses. What type of account is capital? Current.
It's a capital account.
Exactly. So where must it go?
It goes to capital.
Exactly. Okay, so was it a debit or credit?
Pens was a debit of 30,000.
Okay, there we go. Good. So how do I close a capital, or how do I close a current account pen?
You will have to debit the capital.
You'd have to debit the capital, yes, because I would credit this and then debit the capital. Good. Okay, so if we go to pen, current account, what was the amount?
30,000.
50.
30.
30.
Yes.
Okay, great. That's the transfer to pen's capital account. You're closing off the current account of pen. Okay, maybe just to show you that as well. Okay, just as an extract, current pen. Okay, in current pen, you would have had this. Balance, 30. So then you would have had capital pen, 30.
Yeah.
Okay, so this account is being closed off because you had a balance. So there's the credit and there's the debit.
Okay, perfect.
Okay, next account.
Next account is current account for Pencil. So
Good.
that is a debit that will go to the capital account.
Capital account or pencil, right? Debit or credit?
Yeah, but on the credit.
Good. Amount?
10,000.
10.
Yeah.
Great. Okay, so again, if you want to show that separately, I just want to show it to you just in terms of additional understanding. Okay, so there's the credit. So in current pencil, I'm going to show capital pencil. 10,000 was the balance. 10,000 will be the transfer. Okay, so do you have any amount of that account?
No.
No, because have a look. You've got debits and credits equaling no balance. The account is closed.
Yeah.
The account is now sitting there. Make sense?
Makes sense.
Good. Next one.
Next one is revaluation surplus.
What is that?
That will be an asset as well.
Not quite. Almost. It can't be an asset because what balance does it have?
It's a credit balance.
Good. So it can never be an asset.
Of course. It must be a capital then.
Yes, it's either capital, income, or liability.
Yeah.
Right, so use that to your advantage. In the exam, if you ever get stuck, just think about the actual balances. Okay, this balance is a credit, so it can't be an asset, it can't be an expense, and it can't be drawings.
Okay, perfect.
It must be one of the other three.
Yes, I see that now. Okay,
so
perfect.
if you know it's capital, where do I put it?
To the capital account.
Exactly. See, if you know what it is, you'll know where to put it. So where do I put the 270?
So it will be, I suppose, it will be split between the two partners then.
Correct. Okay. So revaluation surplus. All right. Each gets half. So 270 divided by 2 gives me 135 for that partner and 135 for that partner. Correct. There you go. You've done it. Next.
Okay. Mortgage.
What is it?
That's a liability.
Where does it go?
It will go, well, I suppose bank liquidation of capital, it will go to capital as well, because they will have to pay for it.
Okay. Is the mortgage a capital account? You just told me a mortgage is
The liability account.
a liability. So you've got three options: bank, capital, liquidation. Which one?
Sheesh, I don't know.
It's not
suppose-
capital, it's not cash, so it must be
Must be liquidation.
exactly. Okay, earlier on, remember in the notes, we had a slide where you put all the key headings. Liabilities go here, credit side of liquidation.
Yeah. Okay, so it goes to the credit side.
Yeah, what was the account? Was it just loan or mortgage? What was it?
Mortgage.
Mortgage, thanks. Okay, so mortgage is here. An amount?
300,000.
300, great. Okay, next.
Bank overdraft.
What is it?
That's a liability.
Yes, but it's specific to which account?
To
The bank.
bank account. Yes.
Okay, so bank overdraft. It has an unfavorable bank balance.
Yeah.
Okay, so where do I put unfavorable bank balances in the bank account?
On the credit side.
Good. What was the amount?
90,000.
90, great. Okay, next.
Next one is trade payables control. So that's
What is it?
creditors.
Good. Where does it go?
Yeah. That's a liability.
Good. Where does it go?
So it will go to liquidation, I suppose then.
Good. What is the amount?
145,000.
Great. Next.
That's the last one.
Oh, is that the last one? Okay, great. So now
Yeah.
we've covered everything in terms of the easy marks. See, that's easy marks, just for knowing what something is and knowing where to put it.
Okay.
Now we need to get the other marks for the adjustments. Okay, additional info. Right, so on
Right.
30 June, the following transactions took place. Transaction number 1. Land and buildings were sold for 849,500 cash. Give me the workings. Debit what, credit what?
Okay, land and buildings were sold for 849. So we must debit. Debit the assets.
What asset?
Land and buildings.
No, you're not buying more.
No.
If I buy
said-
more land and buildings, then I'll debit it.
Okay. Yeah.
I'm selling land and buildings.
Yes.
So come, give me the working.
So you will credit assets.
I'll credit the land and buildings, fine.
Yeah.
And
And you will. So you're selling it. So. Well, you will. Can't debit the capital account.
you're right, you can't debit the capital account.
No, so you must debit the asset account.
Which asset account? What are you getting?
You're getting money, so the bank account.
There we go. Asset increase. All right, do you have a land and buildings account?
No,
No. Which accounts do you have?
you've got
Bank, capital, and liquidation.
capital.
So where do you think this goes?
It must go to bank.
No. Well, yes, half of it will go to bank. I agree.
Okay.
And where's the other half going to go?
Well, that must go to liquidation then, I suppose.
Yes, because you don't have any account open other than liquidation.
Okay.
All right, so do you see how everything gets closed off to liquidation?
Okay. But why would only half of it go to bank and the other half to liquidation?
When I say half, I meant the debit side. And when I say
Oh.
the other half, I mean the credit.
Okay, perfect.
Okay, but the full amount will get recorded there, yes. So I'm not going to divide it by 2. I'm going to keep it as the full amount.
Okay.
Does that make sense?
Yeah.
How much did you get?
849,500.
Okay, land and building sold. Right, and then here I'll have liquidation, brackets, land and building sold.
Okay.
Right, 849,500.
Oh.
Next.
Next is furniture was sold for 60,200.
So what are we going to do with this?
So we're going to credit furniture and we're going to debit bank.
Okay, can we credit furniture?
No, we don't have a furniture account.
Yeah, so you will credit it inverted commas, but it's actually liquidation.
Okay.
Okay. Alright, so furniture, brackets, sold. Wrong. Bank, brackets, furniture, sold.
Okay.
What did you get for it?
60,200.
6,200.
Yeah.
Great. And then in bank, was it sold for cash? Yes, because
Yeah.
we're liquidating. We're realizing cash.
Yeah.
So liquidation, brackets, furniture sold. And again, the 6,200.
Yeah.
Good. Keep going. Read the next one.
Next one is inventory was sold for 50,050.
Good. So
exactly the same thing. So we would credit inventory. So we would credit the liquidation account.
Good.
And we would debit the bank account.
Good. Total?
50050.
50050. Perfect. There we go. Inventory sold. Next.
Next one is all the debtors, as recorded in the above trial balance, settled their accounts and received a discount of 20%.
What do I do with that?
So that would be, so the debtors were, where are the debtors? Trade receivables, that's at 75,000.
Yes. So what's happening?
So they paid that, but we gave 20% of that away as a settlement discount.
Okay, good. So if I'm looking at the receipt, remember, what is the liquidation focusing on? Realizing cash.
Yeah.
So how much did I realize?
Only 80% of that 75,000.
Correct. Good. So what accounts are you going to affect? Debit, credit?
Okay, so you are going to debit the, well, it's an asset, so you're going to debit the assets.
Which one?
The trade receivables.
No, you're not increasing your receivables. If I did, then I'm selling more.
Oh, yeah. Yeah. Capital.
I'm not increasing capital because there's no owner related here.
Oh, yeah. Shit.
Think about it. They told you in the question, you're receiving payment from them. So, what account's going to be affected?
Bank.
Yes.
No.
Okay. Credit what?
You're going to credit liquidation,
Yes.
the debtors.
Correct. Well done. Yeah, the debtors.
Yeah.
Debtors paying.
Yeah.
Good. There you go. You've got it. There's your debit. There's your credit. All right. So liquidation, brackets, debtors pay.
Yeah.
The total, please. Oh, we need to work it out.
20% of 75.
Yeah, 75,000 times 85%. No, was it 20% or 25%?
20%.
20%, so times 80%. Okay, so 60,000 is what I received. Do you agree?
Perfect, 100%.
Okay, so bank debtors pay.
Yeah.
Debtors pay. You could have done it this way: 75,000 minus bracket 75,000 times 20%. Close brackets.
Okay.
Okay, so if I do that, 75, just to double check, less bracket 75 times 0.20 close brackets gives me, yeah, it is 60. That's fine. Okay, next.
Next is a previous client whose outstanding debtors account of 650 Rand was written off as irrecoverable. Paid 500 Rand to the partnership.
Okay, so what accounts are being affected here? Interpret the transaction.
So it's the debtors account again.
No debtors here.
So it's bank.
Yes, bank, correct. What happens to it?
So it was written off, but we collected 500,000. So we're gonna debit the bank account.
Good. And credit what?
And credit the liquidation account.
Yes. Okay, because we don't have what? We don't have a credit losses recovered account.
Yeah.
Okay, normally you would have processed it through to that account if this was still operating. But
Right.
it's not, so it goes to the liquidation. Okay, so debit bank, was it 500?
Yeah, it says the outstanding account was 650 that was written off, but then it says paid 500 to the partnership. So does it mean the difference is 150?
No, it's how much we received. So what did you actually receive?
We received 500.
Yes.
Okay.
Credit losses
Okay.
recovered.
Okay.
Is that right?
Oh, I'm seeing what they're saying. So we wrote off that 650 and then the guy decided to give us 500 bucks back.
Yes, but the 650 was long ago.
Yes. Okay, that makes sense.
Okay. All right, next.
Next is, there were two vehicles in the partnership. Pen took over one of these vehicles at the fair value of 60,000, and Pencil took over the other fair value of 70,000.
Okay, so whose accounts are we going to affect?
Well, this, I suppose, well, it's assets.
Good. So assets will be affected?
Yeah. So assets will be affected. I suppose you add the two together, so it's 130,000.
Okay, but that's coming from where? Do we have an asset account?
No.
No, we've got a liquidation account.
Coming from a liquidation account.
And what's going to happen to their capital?
The capital will be credited.
Why do you say credited? If we're crediting capital, what are we doing to their accounts?
Goes up.
Yes, we're increasing it.
Yeah.
But what are they doing? Are they taking or giving?
They're taking, sorry. They're taking.
So if they're taking from the business, are they entitled to more or less?
They're entitled to less.
Exactly. So debit what?
So we debit the capital accounts.
Good. Okay, debit capital, pen and pencil.
Yeah.
Credit which account?
Credit the liquidation account.
Very good. Okay, because there's no account for vehicles.
Vehicles, yeah.
Perfect. All right, liquidation account, brackets, vehicles taken. I'm just putting some brackets just to explain what it's for. Okay, what did you say the total was? I think you said 130 if I'm mistaken.
Yeah, that's correct.
Okay, and how much did Pen take?
60,000.
Pen took 60.
Yeah.
And Pencil the 70, I guess, then, eh?
Yeah.
All right, great. Okay, so in that account, let me highlight that in a different color and then we can show it here. Okay, so there's the debit and there's the debit.
Yeah.
All right, this is going to liquidation, liquidation bracket vehicle taken. Okay, same thing here. One is 60, one is 70.
Yeah.
And then in liquidation, which we need to go here, capital pen, bracket vehicle taken, and pencil.
Yeah. Can you add that together? Can you just
No,
say
you
vehicle
can't. You need to show it separately.
Is it? Do you have to?
You have to because different accounts are being affected.
Oh, okay.
Okay,
All right.
Pen's account is being affected by 60 and Pencil's by 70. Two different accounts, two separate transactions.
Okay, perfect.
Next.
Sorry. Okay, the next one says the liquidation costs amounted to 10,000 Rand and were paid.
So
that's money that to be paid.
So
that's bank. Bank
Yes.
would be credited.
good. Okay. Liquidation costs.
10,000.
Correct. Simple as that. Good. And where do I put the other amounts?
So the credit would, I suppose, go to the liquidation account.
Yes. Okay. Because if that's the credit, then I'll have the debit here for the liquidation costs. The liquidation costs were 10,000.
Yeah.
Continue. Next one.
Next one is the mortgage was paid in full.
Okay. So how much was the mortgage?
300,000.
Yeah, it's still here. So I'm going to leave the 3 there. No need to adjust. And if it's paid in full, what do I do to the account?
We gonna debit the bank account.
If
No.
I debit the bank, bank goes up.
Sorry, we can't debit the bank account. We must credit. We've credited the liquidation.
No.
So
This was the initial loan. Now look at the repayments. Separate.
okay,
It's separate. It's not.
So-
It's not this. I'm just showing you the amount that we had earlier.
okay.
Okay. So
Well,
give me
that-
the debit and credit.
So it will be crediting the bank account.
Good. That's perfect.
Yeah.
Liquidation bracket loan repaid.
Yeah.
Bank's
Mortgage
going to
price.
go down 300,000.
Yeah. And
What's the other
liquidation.
account going to be?
Liquidation's gonna go up.
Liquidation is going to be debited.
Yeah.
Yes. Okay. Good. Bank. Correct. Nice.
Okay.
300.
Okay.
Next.
All creditors were paid. A settlement discount of 29,000 was received on these payments.
Okay. So what are we
So-
going to do with that?
So our creditors were paid. That's 145,000.
But how much are we receiving? Remember, it's a liquidation.
Yeah.
So what are we actually
Well-
paying?
Well, we paid 140. Oh no, sorry. That's trade payables. So we paid 145 less 29.
So if you're paying, what accounts are going to be affected?
Well, the bank account will be credited.
Good. See, that's important. So good. Liquidation bracket creditors paid.
Yeah.
All right. It was, you said 145 minus.
Minus 29,000.
Okay, 29,000 discount. Okay, gives us 116.
Yeah, and then we will have to debit the liquidation account.
Correct. Good. Next.
Pencil paid 250 Rand for a farewell luncheon out of the funds of the partnership. So again, we will have to debit the bank account.
Why do you say debit the bank?
Because he took the money from the partnership.
No, but what was this for?
For a farewell.
It was for a farewell for the partnership. So is this a partnership expense or is this a pencil expense?
Well, it will be a pencil expense, but they specifically said out of the funds of the partnership.
Yeah, so it's the partnership that's actually paying for it, not pencil.
Okay.
Okay, so what are you going to do to the partnership's bank account?
You're going to debit it.
No, if you debit the account, you're increasing the bank.
You're going to credit it. You're going to credit.
Okay, so liquidation, bracket, the lunch,
okay, yeah.
250.
Yep.
Okay, so you're reducing the bank, and there's no expense account. So if there's no expense account, we need to show that in
liquidation.
Liquidation, yes. Okay, good. Next.
That's it.
Oh, is that it? Okay, great. So bank, this was the lunch. All right, so now we've looked at the entire question. Let's go back and let's see. Yeah, we've covered everything. So the last bit is just to close off your accounts. Okay, so if we go back to our workings, right, I'm looking at liquidation.
Okay.
Let's balance the account. 500 here, 102, 215, 45, 75. Right, accumulated depreciation 20, 15, 7, 145. All right, so now I need to check. So I'm going to do a little note here. Debits equal, credits equal. Okay, let's see what I get. So if I sum up, all the credits that side, sum up all the debits this side. Okay, which side's bigger?
The right-hand side is a little bit bigger, the credit side.
Correct, the credit is bigger. All right, so the difference is, let's check, this minus that gives us 274. So what is that difference representing? A profit or a loss?
It's a credit, so it's a loss.
It's a credit, so no, the credits were bigger than the debits.
Yeah.
So there's a balancing figure, which is what? A debit.
Oh, yes, okay.
Okay, so the balancing figure is a debit.
Okay.
Capital pen, capital pencil. Right,
Okay.
This difference must be on this side, do you agree?
Yes, yes.
Because if I total those two sides up, what do I want to see on both sides?
The same number.
The same figure, which is the credit amount, right?
Yeah.
Okay, you want to see that amount on both sides.
Yes.
Okay, how much does pen and pencil get?
50% of that 274,000.
Correct, they each get 50% of the difference which is shared. So this is a, inverted commas, profit for the partners.
Okay.
All right, because you're balancing that off here. Does that make sense?
Okay. No, it does.
Okay, let's highlight that in green.
Okay.
Okay, so take that figure, divide by 2, gives me that. Each partner gets 137. So where is that going to go? I can't have debits without a credit.
Yeah, so that will go to the capital account.
Good. Okay, so here I'm going to show brackets, share of the inverted commas profit.
Okay.
Right, equals 137 there. And then the same thing here for this other partner. Make sense?
100%.
Alright, so now have you closed off liquidation?
Yep.
Yes. Have I closed off bank? Not yet.
No.
Have I closed off capital? Not yet. So now I need to close off these accounts.
Okay.
Okay, so let me total up. Total. Let's look at each side of the account. Okay, so sum up the credits. I get that. I want that on both sides. Okay, so the balance will be this amount less the goodwill, less the current, less the liquidation, gives me 272. Okay, so that's 272 as a balance on their account. Okay, then I'll have to do the same thing here on this one. Sum up all of those amounts. Okay, and then I subtract the did I subtract, is the formula referencing? No, not quite. Okay, equals this minus that gives me 232. Okay, so do these accounts have balances? Yes. How do I close off a capital account?
By debiting it.
Yes. Okay, so this last thing is the bank, brackets, paying out the partner. Okay, there's the last bit. You're paying out the partner.
Okay.
Okay, the partner will be paid out that amount. And the same thing here for this partner. Do you see that?
Yeah, I see that.
Okay, so have I closed off pen?
Yes.
Have I closed off pencil?
Yep.
Yes, and where must that go? It must go to the bank. So in bank, you'll have capital pen, capital pencil, brackets, this is the payout. You still okay?
Yep.
Alright, so this is the payout. So equals that. Okay, so now, the formula equals that. Okay, so now, if I've done this correctly, am I going to have a balance on bank?
No.
No, I shouldn't. Let's check. Okay, sum up this side. Enter. Sum up this side. Enter. Okay, good. It did balance. If it didn't balance, then I need to look at the difference and then find my mistake.
Okay, perfect.
Okay, and that's what we've done now in terms of the T accounts. Okay, so this should be in line with what they had in the book, which is what they were closing off. Yeah, liquidation close off, bank close off, capital close off, and that's it. Okay, and that's example 4.1. Right, any questions about this one?
Nope.
It's actually pretty easy, hey?
Yeah, it is, but I think the previous bit was a bit easier.
Okay, the change in ownership.
Yeah.
Alright, so just remember NB, for a liquidation, bracket simultaneous liquidation, what am I going to look at? What accounts are important?
Capital, liquidation, and bank.
Good. Capital, liquidation, and bank accounts. Those are the only accounts that you need to look at. Those are the most important accounts for this particular application. Okay. You're right, Neil?
100%.
Awesome. Great. Okay, so that's it for this week. I will save this and email it to you so you'll get the video and the notes as well. We obviously need to cover, let me just rename this. We obviously need to cover more of these examples. So on Wednesday, we're going to cover the next bit, which is the piecemeal liquidation. Okay, so what happens when I have that scenario, selling things in stages? Simultaneous is pretty easy. As long as you're okay with your debits and credits, recreating these accounts shouldn't be too bad. Just apply the rules.
Okay, 100%.